I get it, you got denied, but the worst part is they won't tell you why. Every single day, people apply for a mortgage thinking that they've done everything right. Credit score, job history, savings, but then they still get denied. And then when you ask the lender why, they hit you with a vague answer like, oh, it was the underwriting decision, right? Or your profile didn't meet our requirements. Let me translate that for you. You're left confused, frustrated, and stuck renting when you were ready to own, okay? But here's the thing, you're right on time. You're at the right place. Don't worry. Today, I'm gonna break down the 5 real reasons why your mortgage application got denied, okay? And even if they didn't tell you. And after each one, I'm gonna give you real examples of exactly what to do so it doesn't happen again. And reason number 1 might just be the most common, but people miss this every single day. Reason number 1, your credit report had a red flag, okay? Even with a 700 credit score, lenders look deeply at the report itself. They're not just looking at the score, okay? For example, I had a client who had a 730 credit score, but they were denied because of an old collection, okay? And this showed up settled for less than the full amount. All right. Now that phrase told the lender that this person may walk away from a financial responsibility. Now, the good news is this typically only happens at bigger banks, okay, like Chase Bank, Fifth Third, but for the most part, not every single bank is going to be that strict on what the account actually says, okay? There's nothing wrong with settling an account, but you may have to do what they call an LOE. An LOE is what they call a letter of explanation, and you just simply have to explain why you settled it or what got into that situation in the first place, okay? Again, this may not happen all the time, but this is something that, again, that typically seems to be most common if people have this on their credit report, okay? And other red flags that are going to be similar to this are going to be accounts that have a 30-day or 60-day late in the last 24 months. Next is going to be high credit card balances, okay? And that's even if you're paying them off. Everyone's debt to income is going to be a little bit different. That's essentially how much money you make, per month versus how many monthly debts you have, all right? And another situation would be authorized user accounts that are hurting you more than helping you, all right? So here's what you need to do. This is how you fix this, all right? Before applying, you need to pull all 3 credit reports and go through it and look at your mortgage scores as well. If you see something that's inaccurate or if you see something that's negative but it seems to be valid, you want to write a short explanation letter going again to that LOE. You don't have to wait for the bank to tell you this. You could just easily just jump ahead of this and get right on it. Also, if you need help understanding your credit report, or if you want to just start improving your credit score right away, go ahead and grab my free credit guide, all right? This is going to break down what lenders actually look for and not just your credit score. Go ahead and scan the QR code right there on your screen or click the link inside of the description below to learn more. Let's move on. Reason number 2, your DTI was too high. Again, this is your debt to income, all right? So that's what DTI stands for. And this one catches a lot of people off guard. And here's why. Let's say, for example, you might make $5,000 a month, okay? That seems to be like a standard type of income that most people may be looking for if they're looking to go into home ownership, okay? But if your car note, your student loans, your credit cards, and your new mortgage total over, let's say, $2,250, that will be 45%. That's a 45% DTI. And many lenders have a cap at 43% or less, okay? So, for example, one of my clients had a $200 a month gym membership, and they had it on auto pay with their credit card. It threw off their DTI just enough to get denied, okay? Until we paused it and then reapplied. Now, another way you could do this is just start paying down some of your debts. So you could either throw a lot of money at like a certain type of loan that you have, pay some credit cards off. Those are one of the easier ways to start doing this. Then here's another fix as well before the process. Use a mortgage calculator or speak with a lender before you apply, okay? If needed, pay down some debt or refinance your existing loans to lower your monthly payments. Also, quick break, because if you're serious about buying a home, you need more than just my YouTube videos, okay? Inside of my private membership, 850 Club Elites, we walk you through improving your credit score the right way. You get a chance to be around other goal-oriented people just like you that not only found out about us through YouTube, but they were able to get back on track with their credit goals. Go ahead and scan the QR code right here on your screen or click the link inside the description below to learn more. All right, let's go ahead and go into reason number 3, all right? So reason number 3, you changed your jobs too recently, all right? Now, here's the thing. Switching jobs might sound like a good thing, especially if it comes with more money, okay? Who doesn't want to make more money, all right? But to a lender, it raises a red flag about income stability. Let me give you an example. I had a client and they got a promotion, okay? And the good news is that promotion did come with a pay raise, okay? But she switched from being a W-2 to a 1099, all right? The lender said we need 2 years of self-employed income. So she got denied. Here's how you fix this, okay? Number 1, stay put at your job until after closing if you are W-2, especially if you know they're gonna change you from W-2 to 1099. Now, if you must switch to 1099 or self-employed, just be prepared to have your tax returns, bank statements, a letter of explanation, and also know that you can't do it until after you've had 2 years of that type of income, okay? Reason number 4, you didn't document your funds properly. And a lot of business owners, they end up doing this. Let me break this down, all right? Having money in the bank is one thing, okay? However, showing where that money came from, that's a different story. Now, lenders want to see that your down payment and where your reserves, that's your savings, okay? A reserve is a monthly mortgage payment that's essentially put up. So let's say, for example, your monthly payment, your mortgage payment was $1,000. They want to see 6 reserve. That's going to be 1,000 times 6, that's 6,000, okay? They want to see where that money is coming from. These are the approved places that they want to see your money come from. Number 1 is going to be your paycheck, okay? Even if you pay yourself, but they want to see a paycheck, okay? Or it can be a gift from a family member or a friend, or it could be a verified savings source, okay? But it can't be like the online payment apps like Zelle, Cash App. It can't just be loose cash, okay? So it's gotta have a paper trail and it's gotta make sense. For example, we had a client and they deposited $10,000 cash after selling their car. Now, there's nothing wrong with doing this, but they had no receipt or bill of sale. So the lender denied the loan due to unverified funds, especially if you're going to be using that money for your down payment. Now, if you're not using that, then you're good. But here's the fix, okay? Keep all of your funds in a checkings or savings account for at least 60 days before you apply, okay? That you also want to go ahead and avoid large unexplained deposits unless you have full documentation. Reason number 5, you applied for new credit during the process, okay? But here's the thing, I want to just break this down further. Even if you're pre-approved, because a lot of times people get that pre-approved letter, they talk to the lender, they feel excited, and you should. It's not over yet though, okay? The lender checks your credit again right before closing. Now, sometimes they have to do this, sometimes they don't, but always prepare for this. And why do they do this? Here's why. If you got a new credit card, a new furniture account, or even a new car loan, it changes your profile and your DTI. Now, don't get me wrong. Can you still do some of these things and still qualify? Yeah, but your income has to be a certain point and the debt has to be a certain point. So the safe answer is don't do it, okay? We had a client get denied 3 days before closing because he financed a new TV. That new TV was $70 a month, and that payment pushed his debt to income ratio just high enough to kill the deal, okay? So here's the fix. Don't apply for anything once you're under contract or once you get the pre-approval. Lock your credit report if you need to, leave your credit cards at home, whatever you normally do, okay? These 5 reasons are the most common ones that we've seen after helping thousands of people improve their credit scores and get approved for homeownership, okay? But here's the thing. It's not just about what you fix. It's about how you prepare for your goals in general, all right? And listen, we want to help you do whatever it takes to accomplish your goals. So we're going to go ahead and see you at the next video.